Live from New York City this morning. Good morning, good morning. The economic data looks good. Yields are up, stocks are down. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, retail sales in America coming in hot. Wall Street banks deliver an upside surprise as Federal Reserve officials line up for the last word. We begin with the big issue, the economist who cried recession.
There's a lot of concern about the consumer.
There's more headwinds now for the consumer.
Still headwinds to the consumer.
How the consumer is faring the inflation pressures.
And a bifurcation of the high-end consumer versus the low-end consumer.
Higher interest rates are playing both on the consumer spend, consumer balance sheet.
Wages, we need to see the economy and inflation start to cool.
There's still ongoing battle with inflation.
Recessionary fears do really come back.
We're already worried about a recession.
They're expecting the U.S. economy to go into a recession.
We're probably going to see slowdown.
We've seen a slowdown coming, and it hasn't manifested.
Whenever that deceleration in the economy does arrive.
It's just too soon to say whether we're truly out of the woods.
Let's start the show with two of the best. Manulife's Francis Donald, Colin Martin at Charles Schwab. Francis Donald, what are we getting so wrong about the resilience of this consumer?
Well, we're in a post-COVID economy, and clearly the traditional economic relationships that have served us so well in the past, they're either muted, they're lagged, or they're completely broken, and we're in the process of finding out which one of those it is. I'm still in the camp that traditional economic relationships still work. If you have less money, you're going to spend less over time. But the time that it takes for these things to hit the economy, clearly we just don't have a very good idea about it. We have not been in this type of economy before. We got to have a lot of humility. And if you're an investor, you better be ready to be pretty nimble.
Colin, what's the answer here? Wait and you'll see it will happen eventually.
I think it'll happen eventually, but I have to agree with Francis, where we look at what's going on recently, the historical relationships that we have relied on, and I think a lot of economists and strategists have relied on, just haven't played out in this cycle because of how crazy the past few years were. Now, if we look going forward, we continue to think there should be some sort of slowdown. When the Fed raises rates by over 500 basis points, that should have a broad-based impact, whether it's on businesses, whether it's on consumers and their spending habits. We haven't seen it just yet. Obviously, it looks like there's probably still a lot of savings still out there. Well, a lot or a little, I guess it's to be determined. But as long as people still have jobs, as long as the unemployment rate remains low, and even if we see modest wage gains, that should keep spending going. But we don't expect anything to go gangbusters from here on out. And I think it all looks at the wage growth story from here. Even though retail sales came in stronger and consumer spending is strong, if we're not seeing a big pickup or a reacceleration in inflation, then maybe that means the Fed doesn't need to act much more, especially based on what expectations are.
There's a lot to unpack there. So let's go through the headwinds for the fourth quarter first. It's interest rates, it's energy, now it's student loan repayments. What are the sources of demand, Francis, that you believe are fading as we come into the back end of the year?
John, housing is frozen. Excess savings are being depleted. We've had one of the most aggressive rate hike cycles of all time, particularly in the context of the debt that exists through this system. And consumer confidence, well, we saw last week, is doing very poorly. But here's the issue. We're so stuck in this binary, is it a recession or no recession, believing recession is bearish and no recession is bullish, that we're missing the story. How likely is growth to reaccelerate from this point forward over the next 6 to 9 months? Probably not at all. And if your math works out to 2 quarters of negative GDP, great. You get to put the capital R word in front of the story. But my takeaway is that recession, a mild recession, is not as bearish as many people believe. When I saw that retail sales number this morning, I actually had a pit in my stomach because I knew yields were going to go up. And those yields moving up as aggressively as they have been, particularly with that speed, I think that's much more painful for investors over the next 6 months than if we got a gentle, mild recession with some rate cuts ahead. We got to change the whole way we're talking about this recession, non-recession story.
So good news is bad news. Francis, yeah?
That's one way to put it. But again, it's about magnitude. 2 quarters of negative GDP with some rate cuts, much better for 12-month returns across the asset allocation spectrum than if we come in for a so-called soft landing that keeps the Fed hiking again or at high rates for all of 2024.
Yields are up this morning by 7 basis points on a 2-year, 5.17 on a 10-year, up 12 basis points, back in the 480s on a 30-year. You can see it on the screen. Threatening 5% again, 496.35, up 11%. 11 basis points right now before I get too excited. Colin Martin, your thoughts on that? Is that bond market a buy?
We still think it's a buy, but I think we have to explain what that means a little bit. It's never a binary decision when we provide guidance like that. We do think a 10-year yield at 4.8% or even slightly higher from the looks of it is attractive, especially when we look at where yields have been over the past 15 years or so. But again, it doesn't need to be a binary decision. Slowly weight in, dollar cost average. If someone or if investors are waiting for yields to go a little bit higher, that's like timing the market. If we're looking at the stock market, we're never waiting for the absolute bottom to consider going into stocks. So we look at the bond market the same way. And if you can get a 4.8% on a 10-year or 5% on a 5-year or 5.5% on the ag, that's been the way we've been describing it for our investors. The benchmark index for high quality bonds with an average yield of around 5.5% we think is very attractive. And that's just a benchmark, because if everyone's super short term, and if you're in short term cash investments, money market funds, that's barely a bond allocation. That's more of like a cash allocation. So slowly move out, take advantage of the rise in long-term yields, but doesn't mean go all in. It's a slow allocation in there and take advantage of what are attractive yields relative to what we've seen.
Yields are up, stocks are down. We're down by 0.6%. Mike McKee has the data. Mike McKee, another upside surprise.
Reports of the death of the American consumer are exaggerated, it appears. We don't know exactly why, but people are spending, and here's what we saw when the numbers came out. A 0.7 gain in September, and August and July revised up, August up to 0.8. The retail control group, which goes into GDP, up 0.6 after a 0.2 gain that itself was revised up in August. Now, you have to deflate these numbers to get a real figure because inflation has figured in, but no, we're not deflating, because if you look at the CPI for durable goods, and I'm using that because basically all of retail sales is goods except for restaurant sales. And you can see that during the month of September and August, CPI for durable goods came down. So we're looking at a 0.6 gain for retail sales in real terms over the past couple of months. Now, what is it that's driving it? It wasn't any one thing, and I want to see if we can pull this up here. The ECAN function for the Bloomberg on the Bloomberg terminal. Go to this if you at all can. And you take a look at this, breaks down, and it's too much to talk about each individual thing, breaks down all of the categories and what they contributed. And if you go all the way over to the right-hand side, you'll see everything contributed this time. There's nothing that really stands out among the things that gained this month. So if you want to analyze these numbers, go to that ECAN function. And that leaves us with the question of how strong is the consumer going forward? You were just talking about that. Well, let me pull this chart out of Bank of America's presentation today on their earnings. They looked at what people are spending on their credit and debit cards during the month. And if you take a look, you can see just over on the right-hand side, retail sales were kind of down. But go all the way left and you can see services, which are not represented really in the retail sales report, up big. So when we get that spending report at the end of the month, if this continues, we'll see some real strength for the third quarter. And people are going to have to be revising up their forecasts, which are already very high.
Something we've had to do repeatedly through the year so far. Mike McKee, thank you, sir. More on the bank earnings around the opening bell. Sit tight for that. This line on the Federal Reserve. Francis Donald, the Federal Reserve sounded more and more like they were out of the game. Does the data bring them back in?
Well, if you look at their forecast, they expect the slowdown to not start in September. That's still Q3 data. And even those economists on the street who have been talking about recession risk, well, maybe we should be quiet until 3 weeks before we actually think the recession is going to start, because even the recession calls are really isolated around Q1 2024. Which is a while to come, John. So we are in an air pocket where we're probably going to have a good macro narrative, strong growth consumer hanging in, inflation coming down across most metrics, and a Fed that, as you pointed out, has been saying, we're going to give it some time. We feel we can back off. That is a good macro narrative. It's just how long is that going to last you? And I agree with Colin. You got to have some flexibility and not be so binary about the call here. I expect that the Fed is going to continue along its line that we heard from Fed member Logan the other day, that the increase in rates is doing some of their job for them. So you have a pocket where you can actually be more bullish on the economy, but it's very short term in our view. By the time those job numbers start to climb, which we think is more December or January, and remember, you get that data later in January and into February, that's when we're going to start to see the realized recession calls. But there's time before then. So getting your timelines right matter a lot, and contextualizing, moving away from that binary in or out, is going to be really critical in the next few months.
Francis, investor hat, you talked about that small window to be bullish on the economy. Does that mean also being bullish on the market? We touched on that briefly. What's the difference between the two?
Yeah, selectively, I think right now you are in a short-term period where the better macro narrative is going to support risk assets, but to a point, because keep an eye on that rates complex. The higher those rates move, the worse the recession risk is going to become. So short-term gains for long-term pains is how I'm looking at this market. You have to get your timelines right, or you're going to end up in a lot more difficulty.
PPI, hotter than expected. CPI, a little hotter than expected. Retail sales, much hotter than expected. Colin Martin, Mary Daly, San Francisco Fed president, got this conversation started with Bramo over the last couple of weeks. If financial conditions, which have tightened considerably in the past 90 days, remain tight, the need for us to take further action is diminished. Mary Daly in the past week. Colin, what brings them back into the game?
I think if we get even more of an acceleration, especially inflation, a lot of the things you mentioned, you focused on PPI, CPI, retail sales. There's no shortage of economic data out there, but I really think what the Fed is focusing on is inflation. We're looking at sort of the short-term numbers. Year-over-year numbers make all the headlines. It's easy to point to that to make it easy for a lot of people to grasp what's going on. If we look at the recent numbers, though, whether it's core CPI or core PCE, on a 3-month change annualized basis, we're under 3%, continuing to decline and getting close to that 2% target. Even if it stalls there a little bit under 3%, I think the Fed would generally be okay with that. What's really going to spook them is a re-acceleration, and we just really haven't seen that yet. I mean, CPI was a little worse than expected. We saw that super core segment come in a little bit hot. But generally speaking, over the past few months, it's not too much to be concerned with, in our view at least. So I think we need to really see a real re-acceleration there, maybe see wage gains pick up, but they've been trending lower as well. So for now, we still think that they can wait and see. In a vacuum, today's number would nudge them a little bit towards a hawkish bias. But if we look at the big picture right now, and especially that decelerating trend in inflation, we think they can sit back and wait a few more meetings.
Colin, Francis, stick with us. If you're just joining us, the data in America, better than expected again. Retail sales coming in hot. So bonds down, yields up, stocks lower. That's the story. Treasury softer, yields higher by 7 basis points on a 2-year, 5.16 on a 10-year, up 11 to 4.82 on a 30-year. Very close again to that line in the sand, 5% on a 30-year. 4.95, up 10 basis points. Equities on the S&P 500 going into the opening bell. About 20 minutes away, we're negative here by 0.6%. With some movers going into the open. Here's Simone.
Yeah, John, one of them has to do with hotel M&A. Choice Hotels offering to buy Wyndham for $90 a share. That's a deal about $9.8 billion and 30% above Wyndham's share price yesterday. But what we're seeing this morning reflects some uncertainty around this transaction being completed because Choice had discussed this for months. Wyndham had broken off negotiations. So here we are. Lockheed Martin also among our movers this morning. Modest beats on the top and bottom line, but we may be seeing some negativity here around their aeronautics division. Net sales, which declined on the back of some disruptions in an advanced version of production of the F-35 fighter jet. Also watching NVIDIA shares. Those are lower and have gone lower over the last half an hour after a Bloomberg scoop coming out that the U.S. was restricting sales of chips that NVIDIA specifically designed for the Chinese market after the Biden administration had gone in and tightened some of its export controls. So this would be, of course, negative for sales. This news, according to a senior U.S. official. Again, this is a Bloomberg scoop, John.
Simone, thank you. Simone Foxman there on the latest. Coming up on this program, President Biden heading to Israel.
On Wednesday, President Biden will visit Israel. He's coming here at a critical moment for Israel, for the region, and for the world.
A week of intense diplomacy. Team coverage up next.
On Wednesday, President Biden will visit Israel. He's coming here at a critical moment for Israel, for the region, and for the world. First, the President will reaffirm the United States' solidarity with Israel and our ironclad commitment to its security. Second, President Biden will underscore our crystal clear message to any actor, state or non-state, trying to take advantage of this crisis to attack Israel. Don't.
President Biden making a high-stakes trip to Israel, emphasizing America's support and preparing to consult on next steps, according to the White House. His visit coming as Israel urges evacuations across the northern Gaza Strip ahead of a potential ground invasion. Trucks carrying critical aid still unable to cross from Egypt as airstrikes continue. Let's start with our team coverage. Ollie Crook joins us from Tel Aviv, Kelly Lyons in Washington, D.C. Morning, Ollie.
Hey, John. So, yeah, this is one of the main focuses is going to be this border crossing in the south of Gaza, Rafah, that goes into Egypt for the aid that you just mentioned. Literally hundreds of tons of aid that are just sitting there waiting to get through. We've heard from the Egyptians. We've heard from the Israelis. The Israelis have said that they want to create the conditions under which this aid can finally move through. But they said it's going to take time. Their main concern is that this aid gets taken and commandeered by Hamas, and they want to make sure that that does not happen. Of course, the other point on Rafah is the fact that there are foreigners still in Gaza that many countries are trying to extract. And then there is the big and complicated question of refugees, John. And many of these Arab nations around the world have said their red line is taking refugees, which is, of course, in part for Egypt being able to take that kind of volume of people, a nation that's already struggling economically, but also at the very essence of this issue, which is people moving and being pushed out of the territory that they consider to be a full Palestine.
Kaylee, a two-part trip for the President of the United States, Israel, Jordan. What are the objectives for President Biden?
Well, he has a number of them as he leaves Washington tonight to go to Israel at the invitation of Israeli Prime Minister Benjamin Netanyahu. And, John, he's making this trip at great personal risk. This is an active war zone, and yet he's doing it because there are a number of things that the president would like to achieve. First and foremost, as we just heard from the Secretary of State, this is about solidarity, underscoring the U.S.'s unwavering support for Israel. This is a physical manifestation of that. But there are other considerations here as well, considering that President Biden is making this trip when Israel is seen as on the cusp of what is expected to be a ground invasion of Gaza. There is also the concern of the fate of the hostages, a number of which held by Hamas are expected to be Americans. And the president would like to see every effort made to retrieve them and rescue them alive. Then there is the consideration of the millions of innocent Palestinian lives in Gaza. There will also be a message sent from the president about restraint, about making efforts to make sure that those innocent Palestinians are protected. This is where the humanitarian corridor, civilian safe zone conversations will likely come into play. Then there is also the concern, and we heard Blinken touch on this, of deterrence, of making sure that this does not expand into a wider regional conflict, a message being sent to the likes of Iran and, of course, Hezbollah, which is another Iranian-backed terrorist group. The U.S. already has been trying to send that message of deterrence by dispatching aircraft carrier fleets to the region. But Biden also, of course, is going to be sending that message by physically visiting the Middle East. And, of course, that second part of his trip, John, after Israel, is to Jordan. He'll be taking part in a four-way summit with the Jordan King Abdullah, as well as Egypt's President El-Sisi and the Palestinian President Mahmoud Abbas, about really trying to make sure that this crisis is contained as much as possible.
Kelly, thank you. Alongside Ollie Crook. Ollie, as always, buddy, stay safe. Joining us now is Francis Donald and Colin Martin back with us. Francis, is it a mistake to view this as a problem for the Middle East and not a problem for the global economy?
Ooh, that's a big question, John. I think right now what we're looking at is the extent of uncertainty. So you're asking a question that an economist or even a strategist doesn't know the answer to. How does that filter into the market view? Well, it's lifting up that term premium, and we've already heard from Fed officials that lifting up of that term premium and rates moving higher reduces their job, but it also clouds the outlook. So we have to apply larger confidence intervals. We've been talking all this morning about how we're not really sure how economic relationships work in this post-COVID environment. Now we're adding on a massive geopolitical tragedy on top of it, and that is clouding the outlook. So again, we've talked about it, but having a wide confidence band, working with scenario analysis, and as asset managers knowing how we're going to react in a variety of situations is effectively the only way forward.
Potentially dealing with the second big military conflict in the last 18 months. Colin, let's work through this together. The comparisons between now and the 1970s. Energy security in America, far better, relatively speaking, in the minds of many. Crude output in America right now through 13 million barrels of oil a day. Record highs. But when you look at the budget deficit, Colin, there are some people who believe this fiscal position is a vulnerability. Colin, do you believe it is?
You know, I think it could be. You can't deny that deficits are rising, Treasury supply is rising. At the same time, we're seeing interest rates rise, which means more money needs to be spent on servicing that debt. And I think that kind of poses a risk to the broader economy, both domestically and abroad. Whether you're a government, whether you're a consumer or a corporation, you need to make decisions when you have a rising debt load and a rising interest rate environment. And where does the government allocate resources? How can they handle their budget, knowing that they have to service the debt? They need to remain current there. So I think it does pose a risk there. I think that's a key driver, or one of the key drivers at least, as to why we've seen yields move up lately. We've seen increased Treasury supply based on the rising deficits. At the same time, we're seeing the Fed's QT continue. And while it's been happening a little bit behind the scenes because the monthly maturities kind of fluctuate, but at the end of the day, we're looking at a balance sheet that's about $1 trillion less or more than where it was about 15 months ago. And so someone needs to step up to buy those bonds. And that's, I think, why we've seen yields adjust higher. They've adjusted higher to attract new buyers to come in to fill in that gap that the Fed hasn't been able to take care of.
Hey, Colin, thanks for being with us alongside the brilliant Francis Donald. To the both of you, appreciate it. Going into the opening bow today, not about the deficit, all about the data. The economic data in America, retail sales better than expected, manufacturing production better than expected, yields higher, stocks lower. Coming up in the morning calls and later, Max Kettner of HSBC said it's time to load up on risk assets once again. That conversation coming up shortly. Your opening bell, 7 minutes away. Equities lower. Let's get you some morning calls. First up, Goldman upgrading Dollar Tree to a buy 137 price target, noting the retailer's strengthening earnings growth potential. Wells Fargo initiating coverage on the home builders, naming D.R. Horton a top pick due to its impressive balance sheet and attractive margins. And finally, Truist cutting its Netflix price target to $4.30, seeing downside risk to subscribers due to the hyper-competitive landscape. That stock is just about positive, 0.1%. Up next, bank earnings keep rolling in with big tech results from Netflix and Tesla on deck. That conversation up next with Max Kettner of HSBC. Your opening bell up next. Really decent, solid, nice day of gains on the S&P 500 yesterday. Taking some of that back this morning. Session lows going into the opening bell. We're negative by 0.7% on the S&P 500. On the Nasdaq, we're down by almost 1 full percentage point. The opening bell rings in New York. Switch on the board and get to the bond market. Yields higher by 12 basis points. Your 10-year 4.8257. The data better than expected. Retail sales looking good. Yields up, stocks down, dollar stronger. The euro 105.50. In the commodity market, negative here by 0.25%, $86 and about 45 cents. About 15 seconds into this session, your equity market looks like this on the S&P, down by 0.75%. On the Nasdaq, down by more than 1 full percentage point. One sector to watch at the open, the financials. Goldman topping trading revenue estimates. Bank of America reporting their best Q3 results in at least a decade. Brian Moynihan, the CEO, saying this: our team delivered another strong quarter. We did this in a healthy but slowing economy that saw U.S. consumer spending still ahead of last year, but continuing to slow. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, a pretty good showing from both banks, and yet shares of both are lower this morning. Let's start with B of A, where traders posted their best third quarter results in at least a decade. Specifically, equity trading revenue jumped 10% to $1.7 billion, boosting net income by 10% as well to 90 cents a share. That is well above the analyst estimate heading in of about 81 cents a share. You also saw net interest income rise about 4.5%, also beating expectations. We open lower, shares a bit higher right now. Let's move on to Goldman, because Goldman traders, they also had a pretty good quarter. Their trading revenue was roughly flat from a year earlier, but that is much better than the 13% drops that analysts were looking for. The not so good news for Goldman, of course, came from the real estate holdings. That saw a second straight quarter of write-downs. Property investments specifically drove a $212 million loss in Goldman's equity book. And you add that to another about $350 million in impairments, and all told, Goldman saw a 33% drop in profit. And of course, that's against a backdrop of still sluggish banking and M&A activity. And you take a look at shares down about 0.5% right now.
Kelly, thank you. 2 minutes into the session, down market almost across the board. Energy, the only sector on my screen right now that's positive by 0.4%. Underperforming information technology down by 1.6. That's the breakdown on the S&P currently. Let's stick with the earnings. Johnson & Johnson raising its revenue outlook on stronger than expected sales from its pharmaceutical unit. The CEO saying this: we posted strong results, significant pipeline advances, and provided a solid foundation for future sustainable growth. Simone Foxman on top of this one. Hey, Simone.
Hey, John, and yet shares are down about 1% in Johnson & Johnson, and the challenge really is where these strong sales and this strong forecast are coming from. Mainly, they're coming from sales of older drugs. Tremfya, the severe plaque psoriasis drug, beating estimates, as was Simponi, the rheumatoid arthritis drug, and especially there's been a lot of focus on Stelara. This treats ulcerative colitis and autoimmune diseases. That's the company's biggest drug, but it's due to lose patent protection in early 2025. There we saw $2.86 billion versus the estimate of $2.58 billion. When we look at the broader revenue outlook for the year, the company now sees $84.4 to $84.8 billion worth of sales. It had seen $83.6 to $84.4 billion worth of sales. One of the things that analysts may also be focusing on, and we see a little bit of this negativity around, is the med tech sales. We had seen a trend of more people doing elective procedures post-COVID, and the company had reported a very good second quarter, but the third quarter was a bit disappointing, seeing just $7.46 billion versus an estimate of $7.59. One thing to watch that we're not going to get today is a study about Rybrevant. This is a lung cancer drug that Johnson & Johnson has been developing. We won't see those results, though, until October 23rd. So maybe that's why we're not actually, frankly, seeing that much movement in the shares today, John.
Simone, thank you. I want to remind you of a quote from JP Morgan's Jamie Dimon in the last week. This may be the most dangerous time the world has seen in decades. Let's turn to defense. Lockheed Martin reporting weaker than expected revenue due to delivery delays for their popular F-35 jets. The CEO is still constructive, though. Our backlog remains robust as both domestic and international orders were strong. Isabel Lee has the story. Hey, Isabel.
Hey, John, it's really the aeronautics revenue segment that's dragging the shares slightly lower as of this morning. Oh, it just flipped higher by 0.4%, but overall, earnings were better than expected, and as we know, geopolitical tensions fuel a sustained demand for military equipment. So going to that aeronautics segment, revenues fall 5% year over year, with the company saying that F-35 fighter jets faced delivery delays. So estimates were around 3.8% decline year over year. And a Pentagon Contracts Management Agency told Bloomberg that parts shortages continue to cause production inefficiencies. So as we know, John, the war in Ukraine has sparked a restocking in arms and ammunition. These include vital guns, and of course, it has provided defense contracts and Pentagons a boost. Still, results were in line with expectations. We have Wells Fargo saying that, okay, it's in line, and we have Vital Knowledge saying this: the results were boring. They were fodder for bulls and bears. So what does that mean? I guess it depends on how you take it, but some analysts were kind of happy. Defense stocks, including Lockheed, has really rallied sharply ahead of the war with Israel and Hamas, John.
A big move in that stock over the last couple of weeks. Isabel, thank you. That stock bottomed for the year October 5th. Since then, higher by about 11%. This morning, basically unchanged. Turning to chips, the US restricting the sale of chips that NVIDIA designed specifically for the Chinese market to help export curbs that block China's access to highly advanced semiconductor technology. Ed Rudlow on top of this one. Morning, Ed.
Yeah, good morning, Jonathan. This is a big move lower on NVIDIA, down more than 5.5%, putting it on track for its biggest decline since May. as expected, because Bloomberg reported in June that this would happen, the US expanding technology export curbs now includes A800 and H800. These are the lower performance GPUs that NVIDIA devised after the US put the original curbs in place last October. The principal difference between the A800 and H800 and the H100 and A100 kind of top tier GPUs is that they have processing speeds that are about 70% of the top tier chips. They can still be used in the AI use case. Now they're hit by these expanded curbs. We also got what we expected in terms of the US requiring licenses for 40 other countries that China may use to circumvent those export controls. In the NVIDIA context, remember how important China is. In the last earnings call, NVIDIA stated that in the data center context, China was 20 to 25% of sales within the historical range. NVIDIA has issued us a statement here on Bloomberg Television this morning saying that it complies with any regulation or export requirements. But here's the key point. We don't expect a near-term meaningful impact on our financial results from A800 and H800 being caught by the curbs. You know, broadly, the market acknowledges, John, that they are supply constrained. Demand for their AI-related GPUs or graphics cards exceeds their ability to supply right now. But big move lower, down 5.7%, on track for its biggest decline since May.
Just one further question on China. Apple, you and I didn't get to catch up on this yesterday. Let's talk about it this morning. Stock yesterday actually finished the session only down by about 0.1%. It's down this morning by 1% and a little bit more. Your view on the reports we had in the last 24 hours, Ed, on maybe some weakness in Chinese markets?
Yeah, the Counterpoint data research and the Jefferies research, which suggests a double-digit decline from sales in the equivalent period of the iPhone 14 last year, kind of contradicts the messaging from Apple, right? You and I have discussed this at length, that in the June quarter, Apple had swung to a top-line gain of 8% in Greater China, driven by iPhone sales. Switchers, which are consumers buying the iPhone for the first time or switching from another brand, a non-Apple brand. What's really confusing is that in the early days of the iPhone 15 Pro going on sale in particular, there were long shipping delays in China, which suggested that demand was great. Now that the dust has settled and you read some of the sell-side research, supply chain constraints might be an issue here. Ironically, the picture in the United States is much improved, where we've seen a lot of weakness in the global smartphone market. So it's a really contradictory picture to what we've seen so far this year, but it is a concern given that a quarter of revenues come from Greater China.
Ed Laszlo, Caroline Hyde, Noon Eastern, Bloomberg Technology. Look out for that a little bit later. Ed, thank you. If you're just joining us, about 9 minutes into the session, equities lower by 0.6% on the S&P. Down a lot more on the Nasdaq, down by about something like 1% on the Nasdaq 100. If you're looking at the bond market, big move higher in yields off the back of better than expected economic data in America. We're up 12 basis points on a 10-year, up 10 on a 30-year, up 8 on a 2-year. Constructive over at HSBC. Max Kettner has this to say. Earnings growth expectations for the upcoming Q3 reporting season look manageable. Financial conditions have now tightened significantly, which should take pressure off the Fed to hike in Q4. Max, I'm pleased to say, joins us right now. Max, let's start with the data. Is good data good news for this market?
It depends, right? It depends on how good it really is. I think it's, when we look at it this morning, right, I think there's been this obsession in the last couple of months and really the last couple of quarters of talking particularly the US economy into a recession, right? So, you know, if we get sort of blowout data like we've had this morning, that certainly doesn't help the rate side. And then, you know, interest rate volatility goes up. And as interest rate volatility goes up, that, of course, does hurt the equity market. And it does hurt pretty much sort of all asset classes except for the US dollar, right, as you're showing right now. So that's really, it depends to the extent of these surprises. I would, however, say, look, when was the last time, for example, where you guys were reporting about really a streak, let's say a couple of weeks of significantly worse than expected data? It's probably been a couple of months already, right? There's this absurdly high obsession with talking the market down, equities down, and with talking the economy down. And in reality, look, things are fine. And particularly in the US, you know, the economy is just really chugging along.
Max, can we talk about the bond market equity relationship? And I'm not sure what comes first, the chicken or the egg, but maybe you can help me. Does this equity market need the bond market to stabilise, or does the bond market need equities to sell off to stabilise? What needs to come first?
Yeah, I think we need a little bit of bond market stabilization, right? So what we've seen in the last 4 or 5 years, I guess you guys have probably had a couple of guests on the show as well that have been arguing through the real rate angle, right? So real rates going up. That's really bad for equity multiples. But let's be honest, those charts, they always start sort of 2017, 2018. Before that, if you look between 2010 and 2017 and 2018, the relationship between multiples, equity multiples and real rates has actually been positive, which kind of makes sense, right? If we're saying, look, real rates up means growth is better. When growth is better, that means that people are willing to pay up, right? They're willing to pay a higher price if things are doing better. So that relationship has only really flipped from 2018 onwards, and it's broken up again about 1.5 years ago, where the relationship now is much stronger and has been really consistently for the last 3.5 years, is not between the level of rates and multiples, but it's really through interest rate volatility. So we need the pace of increase to really calm down a little bit, right? Interest rate volatility to stabilize a little bit, to perhaps subside a little bit. And as that happens, that then will actually stabilize also the multiple, because as you have a bit more certainty around where yields are eventually going to settle, that should then be pretty good also for the equity multiple.
So when you say stability, Max, this is important. We've had this conversation a few times. You're not talking about lower yields. You're talking about smaller moves.
Absolutely. So I'm not genuinely, honestly, I'm not really that bothered about 4.5 or 5%. What I'm bothered about is if someone tells me, look, I don't know where yields are going to be in a year. It could be 3%, could be 10%, somewhere in between, right? But the point is, if you look at the equity risk premium, right, and then think about it from a very top-down perspective, the point really is, if you have in the equity risk premium a bigger uncertainty around the second term, so really around your bond yield, the stuff that you subtract from the earnings yield, what you need is you need a higher earnings yield to basically compensate for that higher uncertainty around yields, right? It's not necessarily the yield itself, it's the uncertainty around where that's going to settle. And as that uncertainty goes down, that also then means that you need not as much of an earnings yield anymore. And that means it's good for PEs, right? It's good for the multiple then.
Max, I want to squeeze this in. Constructive all year. I've got that. Based on the year-to-date performance, right to be. Max, how would you express that constructive view right now? What's the optimal way to do that from your perspective?
Yeah, still underweight developed sovereigns, still overweight equities, maximum overweight high yield credit, right? Particularly in the US, we see very little sort of refinancing risk in 2024. Most of that only comes in 2025. Margins are still pretty stable. So to me, it's high yield credit, it's US equities, it's also energy still, it's LATAM equities, it's high yield credit in particular.
Max Kettner of HSBC. We've got to talk about that high yield call in weeks to come as we close out 2023. Max, thank you. Coming up on this program, another upside surprise on Wall Street.
These banks are actually making a lot of money right now. They're making a lot more in net interest income than they did last year. Trading has been resilient.
Coming up next, Stephen Bigger of Argus Research on Goldman on Bank of America.
These banks are actually making a lot of money right now. They're making a lot more in net interest income than they did last year. Trading has been resilient. Investment banking is cyclically depressed but could bounce back. And so, a lot of these banks understand that you can't necessarily cut your way to glory. And so while we think they're going to be mindful of expense growth next year, I think that the question really is how do they, think about revenue resilience next year?
Another round of solid bank earnings. Bank of America reporting its best Q3 results in at least a decade. Goldman topping revenue and investment banking estimates. The CEO, David Solomon, saying this: "We're confident that the work we're doing now provides us a much stronger platform for 2024. Bloomberg Sonali Basak joins us now with more. Morning, Sonali.
Good morning, John. It is a show me the money story. If you think about what I mean by that, it's not just for investors. It is the capacity to lend. What helped Goldman Sachs during the quarter? This idea that trading revenue, both on the fixed income and equity side, was helped by their capacity to lend to the buy side. Call it Goldman's siren song to the buy side. They are open for business and they are looking to lend over some leverage. Over at Bank of America, net interest income was above expectations. They are lending to the consumer. You have Brian Moynihan saying that the consumer is still strong but slowing. And when they talk about the future of net interest income over at Bank of America, yes, they say the fourth quarter it will trough, but they expect it to grow again in the middle of next year. So both on the consumer side, they are pointing to a brighter future, even with some concerns in the nearer term. And at Goldman Sachs, also for the institutions, you have David Solomon pitching the return of mergers and acquisitions, and they will be there to catch the ball when it lands. Now, Goldman Sachs is, according to Bloomberg's own league tables, back on top of that M&A league table. It was a stiff competition all year long, but they are trying to show you that Goldman is still Goldman.
Shonali, thank you. Goldman right now negative by 0.1%. Shonali Basak, always brilliant on the bank earnings every quarter. Let's continue the conversation with Stephen Bigger of Argus Research. A buy rating on Bank of America, a hold on shares of Goldman. Stephen, I want to go straight to B of A. Let's talk about Bank of America. What is it that's held this stock back all year? And do you see anything in the numbers, the communication from the bank this morning, that turns that story around?
Yeah, good morning. Strong results, I think, and mostly across the board, right? Net interest margin expansion versus the second quarter. We've been looking for lower margins because of the higher deposit costs. We had some loan growth. Deposits actually rose a little bit, flat to slightly higher. So that outflow has stopped. So I think, a lot of good pieces to the story here. Still some concerns about the securities portfolio and the held to maturity. We did have quite a bit of an increase there, about 26 billion quarter over quarter, and that is some concern. It's going to take quite a while to wear off that number as interest rates have increased and put pressure on the securities portfolio.
So, Stephen, you've seen the communication from the bank this morning from the CFO expecting zero losses from that held to maturity portfolio, those securities. Stephen, I was talking about this earlier this morning. Never mind the losses. Does it hold back their earnings potential for quarters and years to come?
Well, relative to other banks, it will, and that probably is measured in many quarters to a few years. And I would reiterate that the holdings there vastly are agency-backed mortgage securities, U.S. Treasuries, so no credit risk here. This is just a function of them earning lower returns until that rolls off. So it does hinder earnings potential. Again, quarters to a couple of years until they roll off and they can get the benefit of higher rates.
Stephen, why do you think the valuation is compelling enough then to buy that bank versus another bank that doesn't have the same problems in quite the same way?
Well, I think they're spring-loaded, clearly for much better earnings as those lower-yielding securities portfolio roll off. So that's one thing. It's a very well-diversified franchise. I think they can catch up with the other diversified banks, which are doing much, much better. J.P. Morgan, Citi, for example, Morgan Stanley have done vastly better stock price-wise than have the regional banks right now. It is cast closer to a regional bank status than it is to the diversified bank. So they will benefit as capital markets revenues improve, whether that's investment banking, M&A activity. Trading results continue to be very strong. So I think they have a lot of untapped earnings potential here that will find its way onto the income statement over the next year.
Down this morning and down something like 20%, close to that level year to date. Stephen, thank you for being with us. Stephen Bigger there of Argus Research on the latest. B of A negative by just 0.07% in early trading. Let's quickly get you some sector price action. Here's Simone.
Hey, John. Yeah, it had been a pie of red to start the trading day, except for energy sector. Now we're seeing some other sectors come into the green. But IT, information technology, still the one that's really dragging everything down. And if we look at the Philadelphia Semiconductor Index, we'll see what has been the impact of this news that the U.S. is restricting NVIDIA's new made-for-China chip sales. This was not entirely unanticipated, but NVIDIA down most intraday since late December, and plenty of other semiconductor names getting hit as well, John.
Simone, thank you. Your trading diary is coming up next. Taking back almost all of yesterday's gains on the S&P 500, down by 0.8%. That's the price action. Here's the trading diary. Coming up, Congressman Jim Jordan expected to hold a floor vote for his speakership bid at noon Eastern. President Biden departed for Israel later this afternoon. Wednesday, more earnings, Morgan Stanley, Netflix, Tesla. Thursday, another round of jobless claims. Plus, Fed Chair Jay Powell headlining a week full of Fed officials ahead of the quiet period. From New York, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.